You're listening to the All-Star Charts podcast with JC Perez on technicalanalysisradio.com.
All right, everybody, we are back with season 3 of the podcast interviews, and I'm very excited. This season, we're going to start out with my friend James Brody of Athena Financial Solutions. James, thanks for being here.
Thank you, JC. It's good to be on. Thank you for having me.
You and I, we've known each other for a while. I mean, you've seen me give a presentation in London before. You've seen me give a presentation in Singapore before. We could dive right into the behavioral finance and the quant, and I mean, we could do this all day. But why don't you maybe tell the audience a little bit about kind of what you've been doing, what you've been up to, you know, as you figured out that how much appreciation you had for behavioral finance and the quantitative space.
Okay, sure. JC, I'll kick off with a bit of my experience, because actually it's quite a humorous the way it started. I'd been working for an accountancy firm, Arthur Andersen, and I wasn't enjoying it particularly much. And one of the banks that I was auditing, speaking with the traders, they offered me a role in the front office there and then. So within 2 weeks, I turned up on a Monday morning to be a trader at what was the biggest bank in the world, Deutsche Bank. And I rocked up. I got there at 9 a.m. I was introduced to my manager, Keith Broughton, and within half an hour, the head of the dealing room came over to me and he bowed and he said, "James, son," and he said, "Here are your derivative trading limits." And I turned to Keith and I said, "Derivatives? What exactly are those?" And he laughed and he said, "I think you better read this book." And this was the early 1990s, and he passed me John J. Murphy's Introduction to Technical Analysis. And that's how I got into the technical analysis side of it. A year and a half later, bond market had a huge move, and I was the only one on the desk still in profit. And I got an opportunity to move to Credit Suisse. So the beauty of Credit Suisse was I moved around the world, and I got to watch and work with some great traders. When I started initially on the treasury desk, and I was funding for the prop team, which most of those left to become Brevin Howard in the early 2000s. I quickly moved on to Sturt trading. Then I moved to New York and ran the bank CD book. Then I moved to Tokyo. I ran the yen Sturt book, so yen interest rates out to 3 years. A year and a half later, I moved to Singapore. I was there for 14 years in all. I ran the yen Sturt, the Kiwi Sturt, and I had proprietary trading limits. Then I moved to TD Securities just as the financial crisis was sort of underway. And there, actually, I finally found out about the CMT, Chartered Market Technicians Association. I took the exams, and I'm now actually, as you know well, I've been on the board of that for 5 years. So I finally realized there's the exams for technical analysis. I took them. I went regularly on Bloomberg TV in Asia. And then they stopped proprietary trading, and in 2010, and I set up a fund with 2 former colleagues from Japan. We traded G10FX and all the crosses. And what was really interesting then was actually learning to code and back testing all my technical analysis ideas. The interesting point there was the things I thought worked actually didn't work. Certain things I didn't think worked seemed to work. And also one interesting observation, I'd never really looked at volatility and volume because the markets I traded, yen Sturt, particularly Kiwi Sturt, not much volume, not much liquidity. In fact, yen Sturt didn't move at all. So that was interesting. But during my career as well, I had 2 big losses, 2 really painful losses. And that's when I really noticed, when I started learning about behavioral finance about 5 years ago, then I really understood that the art of trading, technical analysis, fundamental analysis, behavioral finance, it all kind of fits in together. And so I do a lot of training as well. I do about 40 or 50 days a year maximum throughout the world at banks, private banks, commodity trading houses. And I was asked to do some work on behavioral finance. So I started studying it in depth about 5 years ago. I remember the first book I read was Behavioral Investing by James Montier. I think it's about 700 pages. And every single page, I half laughed, half cried as I went through it, because every single bias in that book I could relate to myself.
You tell me how, one of the things that you like to talk about are some of your biggest losses, right?
Yeah, absolutely. That's when I look back and I look, well, how did I lose money? And when you'd think, well, big losses, then clearly this guy, yeah, he was wrong on the market. But actually, both times, the fundamental view was right, but I lost a huge amount of money. And you say, well, how could that happen? One example, before the financial crisis started, I was trading Kiwi Ster. Kiwi base rates were at 8.25%, and the Kiwi 2-year swap was trading about 8.5%. And we could see exactly what was happening. This was at Credit Suisse. We had a bulletin board, people flashing up what was going on. We could see the Treasury desk had struggling to lend. The credit department had cut back on who they could lend to. We could see the banks that were really struggling to borrow money. The mortgage-backed security desk, credit default swaps. Everyone was piling on what was going on. And I was receiving Kiwi swaps over 8%, 2-year interest rate swaps. And you'd think, start of the financial crisis, what could possibly go wrong? But actually, the yields were still creeping higher. The S&P had fallen off about 8%. We could see what was unfolding. And then the Fed came out and said, we're monitoring the situation. We're ready to cut rates if necessary. So all of a sudden, the S&P, the equity markets started ringing the bells. They went to all-time highs. And all of a sudden, the yields kept backing up, and I had to stop myself out with a pretty huge loss. And that, when I look back, was behavioral finance, because I was so overconfident in my view that I overrode the technical analysis. I was receiving the swaps as they were moving higher, and I didn't have the patience to wait until they rolled over and then start receiving as they were going down. So then the other one was exactly the same, overconfidence. And one interesting point there is I've done the personality test, the NEOAC personality test. I've done it twice in detail. I first found out about that from Jason Williams, the son of the famous Larry Williams, the famous trader.
Sure. Yeah.
He wrote a book, The Mental Edge in Trading. And so I'd done this personality test. And certain things it revealed for me that were good in my personality, the conscientiousness, good sides of that, C1 and C2 say that I'm good for instance, automated trading styles. But what I'm bad at is I'm typically overconfident in my views and I'm over aggressive. So when I have a fundamental view I thought was absolutely right, I'd pile into it in big size, and before you know it, you get stopped out at the start of the financial crisis by having the correct positioning. I brought the chart up today just to have a look at it again. You know, within just over a year, they've gone from a peak of about 8.8% down to just over 3%. And
Wow.
now, of course, they're down at 1.35%. So Aussie and Kiwi yield curves, and it's an interesting point what's happening at the far end of the curves. You look at in Europe, what's happening to the 10-year.
You're saying currently?
Yeah, absolutely. Currently, yeah. If you look at the yield curves, what's happening, Kiwi swaps, Aussie swaps, and they've been received relentlessly. Same with Germany and Europe. A really interesting trade, actually. And I'll come back to behavioral finance in a minute. If you overlay the Euro 10-year swap minus the Yen 10-year swap with the currency, you can see that the currencies are quite a long way out of line, and the euro should be trading really quite a bit lower. But again, the correlation's broken down, but at some point it has to play catch up. But that to me says, well, euro yen should be trading lower, which means first of all, I'm not going to be buying it. But secondly, it means if I want to receive it, then I've got to wait till my algorithm says it's going down.
And for the audience at home, we'll put these charts in the show notes so you can see exactly what James is talking about. So then moving forward, James, what is it that you're looking for in order to, put the trade on? Is there a specific level?
No, what I have is, so taking it the next step further, when we set up the fund, I learned basically coding originally in VBA. So again, we didn't need speed, we weren't high frequency, we were more low latency. And what I did, beginning of 2017, I learned Python. So I've a set of rules I've written up in Python and back tested. And at the fund, we had 5 rules. We had a mean reverting, a trend following, and 3 pattern recognition. Now I just use purely trend following because, firstly, it's just easier to stomach. To sit in there, you're going with the trend, it's easier. Secondly, the returns tend to be bigger. Sometimes you get, we had a slightly better strike rate with the mean reverting strategies, but when the size of the winners was significantly larger for the trend following the mean reverting. So what time frame do I look at? Here's an important point. I don't use it now because now I'm much more automated trading, but I used to use the mark analysis. And one thing I love with the mark, if you look at the weekly charts, the TD setup, so the green 9s for people that are less familiar with it, on the weekly charts, you'll see how often you get these green 9 setups. But to create that setup, obviously it's 13 weeks. You need the first 4 weeks to create the price flip. Then 9 weeks after that of consecutive higher highs than the 4 weeks before or lower lows than the 4 weeks before. But basically, it's a trend that lasts for 13 weeks, which is 3 months. And if you look at those on the charts, you'll see how often you get these 3-month trends. Even a chart that initially with no analysis on it looks like it's gone sideways, you'll see with this TD setup on the week list how often you get these 3-month trends.
It's really interesting that they're consistently 3-month trends that you're seeing. And this is just in the currency markets, or you're seeing this in markets across the board?
Across the board. Yeah, across the board. And, you know, sometimes markets go sideways. But what I do is if I want to be, whenever I put a trade on, I want it to be one of those 3-month trends. And of course, I might get stopped out after 5 minutes. It happens. But what I'm saying is I'm not long term. I'm not buying gold now thinking, you know, I'm going to hold this for retirement or for 5 years. And the reason I look at these, because when you're working at a bank trading or a hedge fund, you don't have the deep pockets to put on a trade that you want to last for 5 years that may go against you for 6 months. And day trading just doesn't work anymore because of the high frequency algorithms. So this is the time period I'm looking at. And again, I'm looking at, you know, equity indices, I'm looking at currencies, I'm looking at commodities, I'm looking at interest rates, so bonds, swaps. What I'm not looking at, actually, something I don't personally look at as individual equities.
Yeah, that's
interesting.
interesting.
Then what it means is to get the 3-month trends, then of course I'm not going to be looking at 200-day or 50-day moving averages because they're going to be, by the time they show up, the market's moved 3 months already. So what I like is, and I've used it a lot of back testing, 8 and 21-day moving averages. So they'll get you in, they won't get you into too many trades, but they'll get you into trades soon enough that if it is going to be one of these trends that lasts for 3 months, then you get to ride it out. You get to get the belly of the move.
Do you mean the 8 and 21 when they cross over each other?
No, I would like if they're both going up is a buy signal, if they're both going down is a sell signal. And I have overlaid with that, of course, it's not just as simple as that, of course, but I have overlaid with that a volatility component, as I say, based on ATR. And I look at MACD, slightly RSI, have a bigger bias of RSI in it, and also position sizing in there as well.
I would be, it would be irresponsible of me not to mention how quickly you passed over that whole, I'm not buying gold for this reason. So there must be a reason why you are buying gold.
Oh yeah, so what I do as well now, I don't have it all fully automated. What I do is I run it in the morning and it will say, you know, maybe buy these 3 assets, maybe sell these 4, and then I cherry pick, you know, I cherry pick then what I want to buy. So right now, for instance, yeah, fundamentally, I think the economy's in a pretty bad place. If you see the data that's come out in the last few weeks, the Morgan Stanley manufacturing index, Empire manufacturing index, we see the PMIs in Europe, we see the semiconductor exports from South Korea and Taiwan, you see electronics exports from Singapore. The UK data, of course, we got Brexit, doom cloud looming over us. So I'm pretty negative. And I mentioned earlier the rates. Yeah, the US 10-year, what's that telling us? Gold breaking out from its base through the 1365, 1375 level. What's that telling us as well? So fundamentally, I'm in a risk-off scenario. So then I'm not buying equities, but I'll wait till the equities give me a sell signal. And as we speak right now, it's interesting. We've had this weekend where we've had the good news or potential good news that China and the US are going to start negotiating again about the trade tariffs. The S&P's opened up this morning in Asia at all-time highs, and now it's breaking down as we speak. It's breaking down to levels that it was trading last week.
What specifically in Asia what was at an all-time high today?
I think looking at the S&P, it opened up this morning.
Oh, got it. So the S&P trading futures, you're saying?
Yeah, S&P futures, the E-mini, yeah, at 2978. I think it got to this morning. Now it's back at 2955. You know, which a level it was trading 5 or 6 days ago.
Let me ask you something, James. You know, you look at markets all around the world, as do I. You know, London's flat for 20 years in the FTSE, right? Euro stocks 600's flat for 2 decades of nothing. So, I mean, at one point or another, I look at these markets. I mean, look at Thailand and Taiwan. Those markets are flat for 25 years. So at one point or another, do we say, okay, these markets have done nothing. They've clearly priced in, whatever it is that's moving forward. But then stocks, simply because of liquidity being put to work, can be driven higher, and we get these multi-decade base breakouts in some of the biggest markets in the world. How do you feel about that thesis?
Absolutely. Again, if you pull up the charts, you say they're where they were sort of 5 years ago, but if you still look at them, they still have trends up and they still have trends down. So there's still money to be made in there. What I think my biggest concern with the markets right now, and what I've seen 27 years of trading, is the low latency algorithms that we're seeing in the markets now. And I think that I've worked with a high frequency company in Singapore. And what's interesting there is they're moving towards low latency and trend following, because they're saying basically the high frequency has become an arms race. The margins, the profits are getting smaller, the costs are going up. And we have now more and more algorithms trading and trend following. And if you see what happened in the fourth quarter of last year in the US, we had the third fastest sell-off ever. And then January, February, March, April, we had the most aggressive rally ever. So my concern is as well, we have this huge leverage, and I agree completely, if the S&P can close at all-time highs, then the money that was taken off in the fourth quarter of last year that hasn't been put to work again could jump in, and again the technical traders will be buying. But again, my concern is when the equity markets do fall, we're getting these aggressive moves down. And on that space, I've worked with an equity derivatives team in London for a major European bank, where not one member of the team was in the financial markets during the financial crisis. So we have recency bias is another behavioral finance. We're used to what's just gone on in the last weeks, months, and years, and we've had a Fed, we've had quantitative easing, and the markets keeps grinding high. And my concern is, when the markets fall, they fall aggressively. But also now when the markets rally, they rally aggressively too. And if you look at commodities, we're seeing the same.
One of the things that I want to make sure that we talk about is that latency, right? So can we focus in on that for a minute? When you talk about the high frequency trading, I mean, we're talking about like just parts of a second, percentage of a second. But the latency, what you're suggesting, what you and I discussed when I was in London recently, is that you're seeing trends, kind of uptrends get longer and faster, and downtrends move faster as well, right? What can you tell me how these latency algorithms are impacting the duration of trends?
Yeah, they don't look at fundamental value. If the trend's going up, they will buy and they will add. If the trend's going down, they will sell and they will add. A few examples. One I talk about actually, and I still talk about it now, iron ore and cotton in April 2016. This was on the Dalian exchange. So this was just one exchange alone. And they doubled in price, both iron ore and cotton futures doubled in price over about 2 to 3 months. And of course, that was on all exchanges. But the volume on this one exchange, Dalian exchange, the amount of iron ore trading each day on this one exchange was equal to China's annual imports each day. Wow. And the amount of cotton trading each day on this exchange was enough cotton to make a pair of jeans for everybody on the planet every single day. And it doubled. Volume went up 30 times. And then, of course, it collapsed afterwards. So it's not just algorithms, of course. In Asia, you have more and more people who are moving from poor to middle class, and of course middle class to sort of to rich. You know, we see more billionaires and millionaires being created in Asia every day than it's far outweighing what's going on in Europe, of course, which is not pretty at all, and what's going on in the US. And the other interesting thing with these retail traders as well is they have a completely different mindset in China particularly. So in Europe and America, people are much more investing for the long term. In Asia or China specifically, it's short, instant gratification, short-term gains, much more so almost a gambling mindset. And as we're saying as well, the algorithms, you know, they're trend following. They don't look at fundamental value. They just keep following the trend. And when the trend starts to turn, they have an exit. They suddenly get out in an instant. When they all start getting out, they rush for the exit. Well, you know, we all remember what happened to the inverse VIX ETF in February of last year. I think one of them fell something like 86% in 20 minutes.
Yeah.
Then in January, was it January the 4th of this year, we had the biggest move in the yen currency in, I think, almost a decade, certainly in Aussie yen. And it was a Japanese holiday. And again, algorithms suddenly raced for the exit and the market got absolutely clattered.
Yeah, we saw something in natural gas as well recently, right? I think it was a fund that blew up. They were picking pennies in front of the steamroller, right?
Absolutely, absolutely. So we're getting these sharp moves, we're getting these extended trends, and we're getting these sharp moves. And again, it's how do we ride that? And one other thing I want to go back to, actually, a really important thing with the technical analysis, you know, to me, it's not a crystal ball, but it's discipline. The thing with technical analysis, it tells me, the algorithm will say, use this technical analysis, it will say, you know, this is going up, so buy it, or this is going down, so I have the choice to sell it or nothing. But the critical thing is, where am I wrong? And that's the absolute beauty of technical analysis. You know, I learned, as I say, with two big losses, when I was overconfident in my view. So every trade that goes on, where am I wrong? And so to me, technical analysis is about discipline. And now what I do is I don't sit in front of the screens all day long, which I did at a bank. And there you have the problem then is you overtrade because you've got to make money. The head of the desk, you have targets, you have people around you making money, all these aspects that are just twisting your arm to put trades on. Now I don't do that. In the morning, I run through everything, run through the algorithms, charts. Maximum I spend an hour going through Twitter, a few people that I follow. You see what the top people are doing on Twitter, you top technical analysts to highlight what's going on. I like Real Vision TV, I rate very highly. The Market EU, I rate very highly for data. And then I'll adjust my positions, I'll put new positions on, I'll adjust stops, and then I'm done for the day.
And then what do you do? Go for a run or whatever? Because you're like a triathlete, right? You're one of these crazy guys that's swimming in Alcatraz, like underneath like the bridge. Like you're one of those, right?
That's right. That's right. That's what I do. Yesterday I did a 2.2K. I had a swim race in the Thames. Thankfully, it's upstream at Henley, so it's a bit better tasting water than down by central London. I've got a bike race in 2 weeks' time, so I do that. Take the kids to school. I read, and also I jump on a plane. I do train. I train on. As I say, on technical analysis, behavioral finance, algorithmic trading. I do course on peak performance as well because I rode for Great Britain. I do Ironman triathlons. It's fun to do that, and it gets me away from just looking at screens or getting bored. It's also, you know, I'm on the board of the CMT Association. It's good fun going. I love listening to the presentations yourself. You know, watching what's going on Real Vision, understanding what people are saying, what people are thinking, so you get an overall fundamental view. But then I won't buy or sell till the algorithms say. So I do coding as well. I test strategies, try and improve strategies. But I try at all costs to avoid looking at screens and tinkering with prices.
Wow, that's great advice. One of the things that you've told me before is that you helped start some of the chapters in the CMT Association out in Asia, particularly where? The Philippines, Taiwan, right?
Yeah, I found it, first of all, I think this was going back 2012, the Singapore chapter. We had 26 people, I think, turned up to the Fullerton Hotel. David Keller came from all the way over from Boston, which was very good. He was a guest speaker. A couple of years later, I founded with Alex Hsu the Malaysia chapter in Kuala Lumpur, and then the following year with Nikki Yu, the Philippines chapter. So I think you've actually spoken all three, and it's brilliant. Obviously, they're absolutely thriving now in Asia. The India chapter has started within the last year, and that's absolutely booming as well.
Yeah.
Technical analysis is a really big thing in Asia.
I've seen it with my own eyes. Like you said, I spoke at the Philippines chapter a few years ago. I was in Taiwan, Singapore. You were there as well. I spoke with Alex Yu at the Kuala Lumpur chapter. Alex had dinner. He cracks me up. He's funny. He's hilarious. Morgan and I, because my wife then, she was actually there, and we all went to dinner, and she was just dying, crying, laughing. He's hysterical.
Excellent. Yeah, they have great fun. But what amazes me in Asia as well is the thirst to learn. And if I go back to when I was banking was it's a great place to learn because the environment you're in and you have limits and you're not trading them with your own money, but it's also a really bad place to learn on the other side because you say you're a trader, but reality, most of these people in banks, including myself most of the time, was actually a market maker, which means you've actually got flow coming into the sales desk, which is like a cushion. P&L's, it's not P&L actually, but money's coming into your trading book by clients crossing spreads, which is what you do as a market maker, but you're not taking risk there. So you're getting this cushion. So if you have some losing trades, well, that gets offset by this money that's coming in. And it's poor for discipline because it's not black and white, your profits against your losses. Whereas the outright prop trading, or if you're a retail investor, for instance, trading with your own money, then it's black and white. You win or you lose. I did some work with a big American bank. It was their Asia Pacific offsite for directors and managing directors. And that was a 2-day program. And it was all about exactly this, that they were taking too much proprietary risk, or they were losing money with their proprietary risk, which was being covered up basically by the flow coming in from the market making and the sales desk.
How much revenue is coming in? How much business is that really bringing in today versus maybe what that looked like in the 90s? Has it changed at all?
Oh yeah, absolutely. Yeah, today it's going to be very slim pickings. But in the early 2000s, there were good spreads. And again, if the more illiquid market you're in, so the Kiwi market, for instance, Kiwi 2-year swaps, you had people crossing spreads, or the fact that New Zealand yen FX forwards, there was just loads of volume. But now that's been cut back dramatically. But then again, banks aren't running the risk they used to either. So the proprietary side is reduced significantly, as well as the market making. Of course, the market making, a lot of it's already automated. The amount of FX traders, forward FX traders in the market's been reduced significantly because that can be done by computers' algorithms.
So I get this question a lot, JC, should I study for my CMT? Should I become a technical analyst? And I think the conclusion that I've sort of kind of realized over the years is that technical analysis is not really like a job. It's more of a tool that can help you in a lot of different jobs. How do you feel about that? And especially in this conversation that the world, the financial world has changed so much and will continue to evolve over time. Technical analysis is just a tool that can help us in a lot of different ways.
Absolutely. Similarly with behavioral finance. Again, behavioral finance is fascinating actually when you study it, because you see biases in all the people around you. The main thing is, of course, spotting the biases within yourself. And there's an actual behavioral bias that says we can identify these flaws in other people, but we typically can't see them in ourselves. But if you see them, it's great as well if you're running teams of people, or I coach kids rugby. You can see every kid there responds differently to how you talk to them. Every kid is motivated. Every human being is motivated differently. We all have different biases. We have different mindsets. We have different psychology. And if you overlay that behavioral finance with technical analysis, it becomes very powerful.
Before I let you run, we have to talk about the market right now. Everybody's wondering, you have your eyes on markets all over the world, not just, stocks, but rates and commodities, currencies, fixed income markets. What has your attention right now the most? Is it that gold breakout? Is it rates near 2%? Bond move could be setting up, right? A mean reversion in bonds. Like, what has your attention?
Absolutely, yeah. The gold has my attention. It's pulling back. It's currently trading about 13.85. I last looked, but it's broken out basically. So it's a great trade to be long. Typically, it'll come back. I think the key breakout level was between 13.65 and 13.75. It's an easy risk reward trade. It's something I don't put that much on Twitter. I'm a bit too busy for Twitter, and I'm not that active on it. But I put it on about a month ago, there was a perfect trend line. It was testing at the bottoms, about 1,275. And I've said, if that was a good buy signal, or if it broke the support line, a sell. But it held. It was a buy. It went up, and then it broke out. It looks like a great trade, and more people are looking at it as well. It's in the press, and at the same time, the 10-year yields are breaking 2%. I saw one analyst call for a reversion at this level, but to me, why go against the trend? I'll only go against the trend. I say if the algorithms I run say actually now it's moving upwards. One thing I've learned is putting on the trade too early, because in 27 years, unfortunately, I've never managed to buy at the bottom and I've never managed to sell at the top. I've done it the other way around. I've sold at the bottom and bought at the top. But I'm too old now to try the mean reversion strategies. And the other thing is with algorithms, the trends carry on longer, so it's harder to pick the top. A couple of equity traders I knew that have pulled out the markets. They say they couldn't fundamentally understand what was going on. So I don't want to be picking tops or bottoms. I don't want to say the bond market's going to reverse at these levels. It's still trending. What I'm more interested in, if the US 10-year can break the it's about 201 or 199 level and carry on lower. What that opens up to me is, and here's another interesting point. I've seen a battle on Twitter by two really great traders who've got a huge track record, and this has been going on for about 6 months. One saying he thinks the dollar's going up, and he has great reason for it, the dollar demand in emerging markets, for instance. The other guy is saying dollar's going down. He's got great reasons as well. The interest rates converging towards yen, converging back towards euro, and twin deficits and other things like that. If you read just one of these articles, it's really compelling to go long a dollar or to go short a dollar. So I just want to wait and watch what happens. It looks at the moment with yields coming lower, the dollar, for me, dollar yen looks like that should be starting to head lower at some point. There's a really key level. If you look at the weeklies, it's around, I think it's around 108 level. So it's only about 50 or 60 points lower. We've got a perfect triangle formation. If it breaks through there, then these are trend lines that go back about 6 or 8 years. That will be breaking lower. Euro yen's another one. If you look at euro yen, overlay that. Euro yen's currently at 122.40. If you overlay that with the 10-year interest rate differentials, I use the Germany on this, and of course yen, then they've been in perfect correlation for the last, well, since early 2016, but in the last 2 or 3 months, the correlation's completely broken, and it suggests that it should be trading 8 or 10 big figures lower. So again, that to me says I'm not going to be buying euro yen, obviously, and now I just wait till I get the signal for it's going down. We've had a double bottom in the last week at around 120.90, but the more interesting point, if it breaks through about 120.20, then the same thing again, you've got a 6 or 8 year trend line, support line that gets broken. And then I think really these currencies really play catch up with what the interest rates are doing. But the one thing that's out of kilter to me is the US equities. But again, equities is a different dynamic because what the central bank's been doing the last quantitative easing. But if you overlay the S&P with the transports and the Russell 2000, the S&P breakout is not confirmed by the others. And as I say, today we've got really interesting, the market opened in Asia, the E-mini opened at all-time highs, got up to 2978, and now it's back at 2957. So it's broken back into where the markets have been trading for the last 6 months, I guess.
What if, because this is what I think about. What is the difference between we're not getting an expansion of breadth, we're not getting confirmation from small caps and transports, right? What's the difference between that and what if we get rotation into small caps and they start playing catch up and transports break out as well? What if we get those, right? So I'm being pulled in both directions to think in that way. So, I think, when small caps started to outperform large caps, that was at the beginning of 2016, and markets did really well in that environment. And small caps to large caps on a relative basis are back to those levels now in early 2016. So it seems to me like a logical area for us to see rotation into some of these underperforming areas. And we do get that confirmation that you mentioned earlier.
Absolutely, we could. If as I say, it's broken back down today, but if the market can break up, then and close above sort of about the 2960 level, money will start to flow in for sure. And then, these algorithms, the low latency algorithms will start buying. The technical analysts that were waiting, they'll start buying. And of course, all the money that was taken off in the fourth quarter of last year that hasn't been put to work, that will start buying as well. And of course, we don't know what the Fed's going to do. If the data starts to come out a bit weaker still, and the Fed does move towards 50 points in July, absolutely, that's going to be really supportive of equities. So again, what I'm trying not to do, I overall have a risk-off view because of what's going on in gold and some of the economic data. But if the Fed are to go 50 and the Russell starts to go higher, transports go higher, and the S&P closes above these levels, then the algorithms that I run will start saying at some point it's a buy, and the world will be buying.
I love it. I love it. Before I let you run, any advice? I get a lot of emails from young technicians around the world. JC, what should I do? Any advice out there in your 3 decades of experience that you wish you knew when you were in your early 20s?
Yeah, first of all, I was lucky. I started with a technical analysis on day one, literally in the first half hour. I wish I'd read a bit more on behavioral finance when I started. I say my favorite book there is probably the first one I read, James Montier's Behavioral Investing, but there's loads of them. The Mental Edge in Trading by Jason Williams, Brett Steenberger, The Psychology of Trading. The other thing is you just can't stop learning. I have on my desk, I'm looking at it right now, I've not started reading it yet, but Market Mind Games by Denise Scholl is a fantastic book. Twitter, there's so much good information on Twitter. Denise Scholl is a good, Brett Steenberger, a good friend, Steve Goldstein, who I used to work with at Credit Suisse, actually. Now he's into the trader trading. He's very much into this behavioral finance as well. He's great to follow. You just can't stop learning. That's what I'd say. Interesting point as well. A lot of research has been done about the winners and losers. So typically, actually, retail traders, this was done by Daily FX 2 or 3 years ago. They picked 15 currencies at random. They had 43 million retail trades. And of those 43 million retail trades, for every currency, there was more winning trades than losing trades. It was something like about 55% of trades on average were winners. But then some research done, I think it was Tudor, the top 10% of traders there. It's also in Jason Williams' book as well. The top traders, typically their win ratio is nearer 41%. It's the low 40s. And it's because trading is about small profits, small losses, and big profits. It's about eradicating the big losses. So the new traders, I'd say, study technical analysis. It's discipline. I'd say study behavioral finance to get a view of yourself, and just keep learning. Trading, it's about small profits, small losses, and big profits. Just make sure you can eradicate those big losses with your stop losses, and just keep learning from all the people out there who are willing to pass on their knowledge like yourself.
I think that's great advice. The fact that there are 4 possible outcomes to any investment. You can make a little bit of money, lose a little bit of money, make a lot of money, or lose a lot of money. And as long as you eliminate that 1/4, the lose a lot of money, I think that's a great stat that the best traders actually had a lot more losses than gains.
The retail traders, 43 million trades, nearly 55% win-loss ratio. For every single currency, more winners than losses. But here's the kicker. For every single currency, the average loss was significantly higher than the average profit. And that's where they get killed.
I believe it. Well, all right, James, thank you. Thank you so much for coming on the podcast. I was really looking forward to this, and I think the audience will really enjoy it.
Excellent, JC. Thanks very much. It's a pleasure. Thank you for having me on.
All right, beer soon.
Excellent. Look forward to that.
Thank you for listening to the All-Star Charts podcast with JC Peretz on Technical Analysis Radio. To see all of the charts mentioned on today's show, please visit allstarcharts.com/podcast.